Welcome, everybody, to Tokens of Wisdom. I'm your host, Dave Rothschild, a partner at Cole, Freeman & Mallon, a boutique law firm based in San Francisco with one of the leading private fund practices on the West Coast. Now, before we dive into today's episode, please listen to the disclaimer at the end of the show. You know what I'm about to say. Nothing I say here is legal, investment, or tax advice. All right, well, today's going to be the first in a series of Tokens of Wisdom episodes that summarize the main offering terms that go into a fund. Now, one of the first things I do with any new fund launch client is I send them what I call the fund questionnaire. Now, I actually have like 4 or 5 different versions of the fund questionnaire, depending on what kind of fund it is. But anyway, I send clients this document, and it's almost like an SAT exam. It's like a multiple choice document that walks through each offering term and gives my new clients the chance to fill it out and say, yes, I want a management fee, and yes, I want it to be 2% per year, things like that. Now, for a typical new client, this call is going to last about an hour. And over the course of that hour, we're going to have some back and forth. We're going to talk about the offering terms. I'm going to tell them what I think is market, what I think is a little bit too aggressive, what I think is not aggressive enough. But by the end of that 1 hour call, I have most of the information that I need to start putting together that fund's offering documents. Now, I know that you Tokens of Wisdom listeners, nay, viewers, like it short and sweet. So instead of doing a full hour-long call where I'm talking to myself, I'm going to break it up into different sections. So I'm going to start with open-ended funds or hedge funds. Yes, I realize that not all open-ended funds actually hedge their positions, but that is irrelevant. The term hedge fund is what I use to refer to open-ended evergreen funds. So I'm going to do a series of episodes that talk about the offering terms for hedge funds. And first one, today, we're going to talk about compensation terms. Ooh, baby. Exciting stuff. I mean, this is why you get into running a fund in the first place, right? Everybody wants to make a little money, and the way that fund managers make money is through the compensation mechanics in their offering documents. So without further ado, let me pull out my trusty questionnaire. Yes, I am so old that I still like to print it out sometimes and fill it out on paper. No, I don't actually need to fill it out as I am talking to myself and discussing a fake fund. Now, most hedge fund managers will earn 2 different streams of income from running the fund. One is a management fee, which is a periodic fee that is assessed against net asset value of each investor's capital account in the fund. So, for instance, I'm going to charge 2% per year. I'm going to charge that periodically, usually monthly or quarterly, but sometimes semi-annually or annually. And so if I have a 2% annual management fee that's charged monthly, I'm getting 1/12 of 2% every month. The second stream of income is a performance allocation, sometimes called an incentive allocation. That is a share of the profits that you made for the fund in that year. So let's say it's 20%. I make the fund $100 over the course of a year. That means that at the end of the year, I get $20 of that 100. And the investor gets the other 80. That's how a performance allocation works. Mechanically, why is it called an allocation instead of a fee? That's a really great and crucial question. If you get paid a fee for managing a fund, that is ordinary income, and you're going to pay taxes on it like you would on any other piece of ordinary income. However, if you are allocated a percentage of the profits generated by a fund within that fund vehicle, then you might be able to take advantage of the underlying tax character of the income generated. So, for example, if I'm generating long-term capital gains at the fund level and my performance aspect of my comp is structured as an allocation, then hopefully that $20 of income that I gave in the example earlier will also be taxed at long-term capital gains rates rather than at ordinary income rates. Why does it work this way? I have no idea. This is what some people sometimes refer to the carried interest loophole. I think any politician, right, left, or center, likes to bash the carried interest loophole when they're running for office, and then they do nothing to close that loophole once they are in office. Quick recap, 2 streams of income. Management fee, assessed periodically based on the NAV of each capital account in the fund. Performance allocation, assessed usually annually, though sometimes on a different cadence. And that's a percentage of the profits that was generated during the period. Okay, great. So we got a new client launching a new fund. We're going to figure out what the comp terms are. So the first question I'm going to ask you is, will your fund pay a management fee? And the answer is typically going to be yes. Now, that's not always the case. Some funds will have no management fee, and that's a nice selling point for when you're going to pitch prospective investors to invest in your fund. Hey, there's no management fee here. That's a great deal for you. You should invest. However, I think historically, fund managers used the management fee to pay the expenses of running the business. So typically an investment manager has some expenses, right? They have to pay their employees, they have to rent office space. These are typically expenses of the investment manager entity. And the management fee was generally seen as the revenue stream managers would use to pay those expenses. Now, depending on the size of your fund and how heavy your expense load is, it's entirely possible you're collecting more management fees than you have as expenses, in which case you're pocketing the difference as income. So yes, there will be a management fee. So my first question is, how much? What will the management fee be? And you're usually expressing this as an annual percentage. So an annual management fee equal to 2%. You might have at some point heard someone refer to fund manager income as the 2 and 20. That was kind of the historical standard for what a hedge fund manager would make, a 2% management fee and a 20% performance allocation. As with anything else, as the competition gets stiffer and more managers come along, someone's willing to offer attractive investment strategies at a lower cost. And so price pressure moves those compensation numbers down. I think if you're launching a long-short equity hedge fund right now and you try and charge your investors 2 and 20, unless you have an incredible pedigree, I think you're unlikely to get that level of fees. I think that's probably too high for that kind of fund. However, if your investment strategy is more bespoke, or you have a particularly proprietary investment strategy that really can't be replicated elsewhere, you might be able to justify a 2% or even higher management fee. So after you tell me, okay, I'm going to charge 2% management fee, and after I tell you that that's probably too high and you're going to get investor pushback, my next question is, how frequently will it be assessed? Will it be monthly? Will it be quarterly? Will it be something else? And then, okay, great. You tell me you're going to charge it monthly. And now the next question is, are you charging it in advance or in arrears? Meaning, are you taking your management fee on the first of the month based on the capital account values at the first of the month? Or are you taking your management fee at the end of the month based on the capital account values at the end of the month? I usually see in advance, probably because most of my emerging manager clients want to be paid as soon as possible. But I do see management fees charged in arrears quite frequently as well. So if you charge it in advance, especially if it's quarterly or less frequently than monthly, I'm also going to ask you if you would refund a pro rata portion if somebody withdraws intra-period. Yes, most clients will refund if they charge a management fee in advance and someone withdraws in the middle of that period. And that's kind of it for management fee mechanics in a hedge fund. It's really not that complicated. How much are you charging? How frequently are you charging it? So moving on, the second stream of income is the performance allocation. And there are a few more variables in this one, but it's not all that complicated either. Like I said, performance allocation is what is the GP's share of the profits that they generate during the period. So usually performance allocations are assessed annually, but sometimes they're assessed more frequently than that. So again, here, the first question I'm going to ask you, dear fund manager, is, will your fund have a performance allocation? And almost universally, the answer is yes, because this is where the fund manager makes the bulk of its money. Like I said earlier, if the management fee is designed to cover the manager's expenses, the performance allocation is designed to let the manager retire once they're my age. So yeah, the performance allocation is where the manager is going to really cash in. If they have a monster year, they're going to take 20% of those profits, and the next year they might be closing up shop and moving to the beach. Who knows? So yes, you're going to charge a performance allocation. My next question is, what is the number? If the traditional standard was 20%, it's probably a little lower now for your typical hedge fund. Same considerations apply that I just discussed with respect to the management fee. If you have a more specific, more bespoke, more proprietary strategy, you probably have more leeway to charge a higher performance allocation than you do if you're just managing long-short equities fund. Okay, so you're going to charge a performance allocation. It's going to be 20%. Now, how frequently are you going to charge it? Most typical is annually, and for the vast majority of funds, that means calendar year. So on December 31st every year, before they pop the champagne to celebrate the turning of the new year, they calculate how much they made for the fund and how much of that is going into their pockets. Now, there's a couple pieces that go into performance allocations that you should be aware of. So the first is a high watermark. I'm going to ask you, dear fund manager, if your performance allocation will be subject to a high watermark provision. And again, here, the answer is almost universally yes. What is a high watermark? Well, I'm glad you asked. A high watermark prevents a manager from being paid a performance allocation in a year when the profits of that year are just making up losses from a prior year. So I'm going to give you some really basic lawyer math to illustrate this point. Let's say I put $100 in your fund. Your fund has a 20% performance allocation charged annually. At the end of year one, my capital account is worth $90. So it has gone down $10. Now, in that example, there is zero profit at the end of year one and thus zero performance allocation because 20% of zero is zero. Now, let's say in year two, your capital account goes from $90 to $95. Now, in year two, you've got $5 of profit. So without a high watermark provision, in year two, I am pocketing $1 of performance allocation, even though those $5 in profits were just making up losses that I had suffered in year one. So a high watermark provision says, no. Notwithstanding the fact that you made profits here in year two, my capital account is still below its high watermark. And as a result, you're not getting any performance allocation. Because if you look at my investment from when I started, I'm still underwater. And therefore, you are not getting paid on that performance allocation. That is a very typical, I dare say, universal mechanic. All right, I'm exaggerating a little bit, right? There are exceptions to every rule. And some fund managers, I'm sure, have gotten away with putting a fund together that did not have their performance allocation subject to a high watermark. Someone had enough cachet to convince folks to give them their money anyway. But it is overwhelmingly common to have a high watermark. There is a bit of a twist on the high watermark, which is known in the industry as a modified high watermark. Now, what a modified high watermark says is that if you lose money in one year, then in future years, you're going to get a reduced performance allocation on profits, even just profits that make up prior losses. But that reduced performance allocation is going to continue to apply until you've made up some multiple of the initial losses. So let's stick with my $100 example. Year one, I invest $100 in the fund. End of year one is worth $90. No performance allocation because there have been losses. End of year two, it's worth $95. Now there's been $5 of profits in year two. If there's a traditional high watermark, I'm getting nothing. If there's a modified high watermark, I am getting some reduced performance allocation on that $5 profit in year two. So to make the math easy, let's say you reduce the performance allocation in half until you've made up twice the amount of the losses. So when I made $5 profit in year two, I'm going to take 50 cents of performance allocation because that's half of the ordinary 20%. Now that reduced performance allocation is going to continue to apply until my capital account is worth over $110, until I've more than doubled the amount of the loss. The idea here is there is a competition among fund managers for investment talent. And the way that fund managers attract talented investors is they promise to give them a percentage of the performance allocations that they earn. That's the bonus income that manager employees receive. If a fund experiences a significant loss in a given year, which is possible for any fund, no matter how talented the investors behind the curtain are, then it's going to be a long time before they're able to make up those losses and start earning performance allocations again. And so if a manager finds itself in that boat, it might be afraid that its most talented investment professionals are going to leave for new managers that aren't in the hole. Because once that fund is in the hole, they've got to dig all the way out of the hole before they start making profit again and earning incentive allocation. If they're not earning any incentive allocation, there's no bonus money going to their employees. Their employees might leave and go elsewhere. And that makes it even less likely that the manager is ever going to dig out of that hole because its most talented climbers are moving on to greener pastures. And so someone came up with this modified high watermark concept. Basically, it's a way for a manager to continue making some performance allocation so that it has some bonus money to throw around to employees so that it can retain those employees to climb back out of the hole, get back into the black, and start generating profits again. I very rarely see modified high watermarks. I almost always see your typical run-of-the-mill high watermark provision. Okay, that was a really long-winded explanation of a term that you're almost certainly never going to use, but, I am thorough. So you got a 20% performance allocation assessed annually, subject to a high watermark. The last question I'm going to ask you, the second last question I'm going to ask you is whether it is subject to a hurdle rate. Now, think of a hurdle rate like a preferred return. It is an obstacle that you have to overcome before earning a performance allocation. So, simple example, let's say you have a hurdle rate of 5% annualized. That means that my capital account has to beat 5% before the manager can get a performance allocation. So if you make a very small amount of profits, but your profit is below the hurdle rate, then the manager's not getting any performance allocation that year. They have to beat the hurdle rate in order to get a performance allocation. Now, I think hurdle rates are not super common among hedge fund clients, but they're not unheard of either. You'll see hurdle rates from time to time. Investors like it, obviously, because it gives them some comfort that the manager has to hit certain profit targets before the manager can really get paid. It incentivizes the manager to make the fund as much money as possible. But I still don't see it as frequently as you might think. Now, if you do have a hurdle rate, if you say, yes, I want to have a hurdle rate, my next question is going to be, is it a hard hurdle or a soft hurdle? What's the difference? Well, a hard hurdle says that if you exceed the hurdle rate in a given year, then the manager gets a performance allocation, but only on the amount of profits in excess of the hurdle rate. If it's a soft hurdle rate, as long as the investor's account hits the hurdle rate, the manager gets 20% of all the profits. And so that's the difference. And that's kind of it, folks. If you're going to start a hedge fund and you want to figure out how your investors are going to pay you, rewind and listen to the last few minutes and you got everything you need. Thanks for listening to Tokens of Wisdom with Dave Rothschild. I hope you enjoyed this episode. Please like, follow, and subscribe to our show wherever you get your podcasts. Well, now that all that boring stuff's out of the way, it's time for the part you've all been waiting for. The legal disclaimer. In this show, I describe laws and regulations from a 10,000-foot view. And while this should be obvious to most, I need to say it nonetheless. This show is for informational purposes only, and nothing I say here constitutes legal, investment, or tax advice. If you're thinking about starting a fund or you're curious about your options, this show is a good resource. But if you're going to pull the trigger and launch a fund, please engage an attorney to assist you.